All right, hello everybody, this is Mike Rixey. I am the lead options instructor for Netpicks, and this is our options trade of the week. In previous videos, I have shown the Thinkorswim platform, as that's the platform that I use for most of my charting and my own personal trading. But I did get some requests over the last week for the Tastyworks platform to be shown, and that's what you're looking at here on the screen. For those of you that are not familiar with Tastyworks, they were formed by the same group that started Thinkorswim years ago, before Thinkorswim was bought out by TD Ameritrade. It's one of the newer platforms in the industry. It's a phenomenal platform, but their commission structure is by far the best in the industry. They charge a flat $1 per contract commission, but they only charge to get into a trade. They do not charge any type of a closing commission. When you're only paying the commission on one side of the trade, that is a huge cost savings come end of the year. But they take it a step further. They actually cap their commissions at $10 per trade or $10 per leg if you're trading a spread. That's going to save you a bundle compared to any other broker in the industry. It's a huge savings. So I highly recommend them as a broker. The only issue I have with them is their charting capabilities are very limited. They have enough available to where if you're just looking for price action, looking to use some very basic indicators, that's fine. But anything custom, anything advanced, it's going to be very limited. So I don't use them all that often for charting, but as far as taking trades with, it's a no-brainer. You will definitely want to use them if you're trading options. So for this week's trade of the week, inside of the Tastyworks platform, we're going to take a look at GLD. This is the gold ETF, which has been very, very active over the last number of weeks. You can see here on the chart, this is just a 3-month daily chart of gold, and you can see the expansion that we've seen in price. It's been an impressive rally to the upside. Now, we could argue why that's been the case. It could be what's going on with the dollar, what the Fed is doing with interest rates. It could be a reaction to what's going on with the trade war with China. It doesn't matter. Bottom line is price action has been on a tear to the upside. And because of the uncertainty that we're seeing globally, the market makers are pricing in that uncertainty by elevating the volatility. The implied volatility is a big input in how the options are priced. When the volatility gets high, the options are more expensive. Anytime that you're trying to sell anything, it could be a stock, it could be an option, it could be your house, a car, anytime that you're a seller of an asset, you want to collect as much as you possibly can up front, correct? When the options get expensive, when volatility gets high, I want to be a seller of an option. It's going to help stack the deck in my favor. Because the volatility is high on GLD right now, the options are more expensive, and I would rather put on a trade where I can take advantage of the options being expensive with the hope that they're going to get cheaper going forward. And I'll take a look at that in more detail when we get over to the trade page and we'll start to piece this trade together. Well, if we take a look at price, it's certainly been an impressive move. What we typically see on stocks or ETFs that make moves like this, oftentimes you'll start to see a period of consolidation, potentially a pullback and a reversal. And that's exactly what I'm expecting here on gold. In the near term, I'm expecting a period of consolidation. Long term, I'm still very bullish on gold. I think over the next few years, we are going to see gold rally in a big way. But in the near term, it is due for a pause, and rightfully so. It's been an impressive move to the upside. Based on this chart pattern, I want to put on a trade that would leave me with more of a neutral outlook. And for that, we're going to use what's called an iron condor. I know the name sounds a little funny. When we break it down in detail in just a moment, you'll see it's not anything overly complex. That's why I dislike the name of the trade, because it can be intimidating. It's actually a pretty simple trade, and it's also a very safe trade. So let's jump over to the trade page and we'll break it down in more detail. So I'm going to click on the trade tab here in the middle of my screen. It's going to take me to the trade page for GLD. If you're not already at GLD, you just have to type in the symbol here up at the top. It's going to show us all of the expiration cycles that we have available to us, along with the number of days left to expiration in the middle column here. For an iron condor, I typically like to go out at least 40 days. You can do this type of a strategy with the shorter term weekly options, that's fine. I like to go out a little bit further in time because it takes the directional pressure off the trade. I can hold the trade longer in order for my outlook to be proven right. If I trade this with a weekly option, there's not a lot of wiggle room there. I either need to be right off the bat or I'm in trouble. And knowing that we're going into the summer months, knowing markets tend to be a little bit slower, I want to put this trade on and not have to stress about it all day, every day. So we're going to go out to the August monthly options. Those are the options with 49 days left. I'm going to go ahead and click on those to open up the different options that we have available to us. The Iron Condor, while the name is a little funny, all it means is that I'm selling an out-of-the-money call spread and an out-of-the-money put spread at the same time. It's creating a range that we expect that stock to stay inside of. And that range is what we refer to as our profit window. I don't care if gold moves up, down, or sideways. As long as it stays inside of a defined range, I can make money with this type of a trade. Let's take a look at the call side first. We've got the call options on the left-hand side here. We've got the put options on the right-hand side. We're going to take a look at the call side first. Let's go ahead and take a look at selling an out-of-the-money call spread. And for this trade, I'm going to come to the 137 call. It's roughly $4 out of the money. And I want to sell that 137 call. To do that, all I have to do is left-click on the bid price of the 137 call, and it boxes in that option in red, indicating that I am selling that option. Well, I mentioned it needs to be a safe trade. I want it to be a risk-defined trade, so I also need to buy another option at the same time, and for that, I'm going to buy the 138 call. To do that, I'm just going to left-click on the ask price of the 138 call. It boxes that option in green, indicating I am buying that option. This is what's known as a vertical spread. I'm selling the 137 call, I'm buying the 138 call to make it a risk-defined trade, and I'm actually collecting premium up front. I'm getting paid to put that trade on. Now, because we're using an Iron Condor, I also need to sell a put spread as well. And because I sold this call spread, and I sold the call, the 137 call, that's $4 away from the current stock price, I also want to sell the put option. That's $4 away from the current stock price. So if I go to the 129 put, that is also $4 away from the current stock price. To sell that option, I'm going to left click on the bid price of the 129 put. That's going to box it in red, indicating I am selling that option. And then I'm going to buy the 128 put at the same time. To do that, I'm going to left click on the ask price of the 128 put. That indicates that I am buying the 128 put. With the price of the stock at 133, you can see the 133 option, the one that I'm putting my cursor over, that is the at the money strike. Notice how my call spread and my put spread are equal distance away from the current stock price. This is what we refer to as our profit window. Well, what I'm trying to do is box the price in. The current price of the stock really should be right near the center of my short strikes, right near the center of the 137 and the 129 strikes, which is exactly what we're accomplishing here. By doing that, this is a neutral trade. I don't care if the stock moves up, down, or sideways. I couldn't care less. As long as it stays in between 137 and 129, I get to make money. So if we just bounce around in here, if we chop dead sideways going into the summer months, I can still make money from this trade. And in fairness, okay, my profit window is actually a little bit wider than that because you can see the price down at the bottom. I am collecting 48 cents or $48 per spread to put this trade on. So we can actually factor that in, and our profit window is actually a little bit wider than just the short strike. So we have a little bit of a cushion here, which is nice. The $48 that I'm collecting to put this trade on is the most I can make on the trade. This is not going to be a home run profit potential. An Iron Condor will never make you a 500% return. It's just not the nature of this trade. This is a trade that you would put on if you're expecting a slower sideways move. If you're expecting a slower market here in the summer months, if you're expecting the stock to stay slower because it's coming off of a big directional move. This is a trade that you can still generate some income even if the market's not making a big move. If you're expecting the market to stay active, or if you're expecting a big directional move, there's far better strategies to use. And we've covered those in previous videos and in earlier Trade of the Week recaps that we've done. This is a way that we can add in another layer of diversification, not require the market to make a big move in order for us to make money. This is the missing piece for a lot of people. If the market's active, if the market's moving, there's a lot that we can do with options to make money. Where you're going to separate yourself from most other retail traders is when you can add strategy like this that'll allow you to make money when the market's not doing anything. While everybody else is just spinning their wheels, losing money in a slow consolidating market, this is a way for you to stay active and generate some income. Now, I mentioned it's a very safe trade. Take a look as I click the confirm and send button. the most I can make on this trade is $48 per spread. The most I can lose on this trade is $52 per spread. If I am dead wrong on gold and gold continues to explode to the upside, the most I can lose on this trade is $52. You can put this thing on 10 times and still have around $500 of risk. You put it on 10 times, now all of a sudden you've got close to $500 of profit potential. So it's a great way to get right around risk one to make one. Great way to generate some income. And again, I can make that $500. If I put this on 10 times, I can make $500 from gold doing absolutely nothing. Now, how does that make sense? How do I make money on this trade? Anytime that I sell an option or if I sell a spread, the whole goal is for those options to get as cheap as possible, as quickly as possible. Because I'm selling this spread up front, I'm looking to buy it back down the road at a cheaper price. What would cause these options to get cheaper is if time decay adds up. Every day that passes, that we stay inside of our profit window here, that time decay works in our favor. We also make money if volatility decreases. We mentioned the volatility on GLD right now is elevated. It's expensive. What I'm banking on is volatility starting to normalize, starting to come back down. And if that happens, it's going to cause the options to get cheaper. That would also allow me to make money. So you have to kind of have a transition in your thought process. A lot of times you learn about options. If you're bullish, you buy calls. If you're bearish, you buy puts. And those are directional bets. You're hoping for the stock to make a big move. This type of a trade with an iron condor is a bet on time decay helping you and volatility decreasing. That's how you're making money on this trade. So it's not going to be a position that's going to hit full profit in a day or two. Going out 49 days, this is a play where we're going to have to hold on a little bit. We're going to have to hold on for a period of a number of weeks in order to hit a profit. The cool part about this is going into the summer months, I don't know about you guys, but I have no desire to watch the market 8 hours a day. This is a trade that we can put on, not have to track it super close. We can just let the trade work for us, maybe check it, once a day, check it a couple times a week, and we're good to go. So it frees up your schedule, allows you to stay active, make some money in a slow, dull market. And again, what I'm looking for here is for price action to stay in between 137 and 129. As long as that happens, I don't care what price action does. So when I come in and check this on a daily basis, all I'm looking for is, are we in between our profit window? Are we inside of the profit window, which is defined by the options that we're selling? If price action is there, we can continue to hold the position and just let time decay help us. Okay, so perfect type of a trade. This is not something that we're going to want to do exclusively. I don't want you to trade iron condors across the board. It's another way of adding in a layer of diversification, taking the pressure off, needing the market to make a big move. So we'll add this to our list. We'll certainly track it here over the next few weeks, see what happens. How would we manage this trade? Initially, our target level is going to be 75% of whatever I collect to put this trade on. If I can collect 48 cents, which is where it's trading right now, if I can buy this thing back for 12 cents, that would give me 75% of my max profit potential, and that's going to be my initial target zone. Because we're going out 49 days on this trade, this is not a trade that we have to worry about timing-wise. If you don't get it on until next week, not a problem at all. You'll have plenty of time to get the trade on, and then the P&L is not going to be ultra active, at least initially. So it's not something that we'll have to watch all day, every day. All right. So that is our trade of the week on gold. Before we wrap it up, let's go ahead and take a look at some of our previous trades of the week that we had open. Let's take a look at eBay. This is from a couple weeks ago. We came in and we actually used the July 19 options. Those are the monthly options. And we sold the 42 call spread. So let me go ahead and pull that order up. We collected 61 cents to put this trade on. We sold the 40 call. We bought the 42 call to make it a risk-defined trade. We wanted this thing to stay below $40.60. As long as price action stayed below that level, we got to make money. Now, eBay has not really made a big move lower. We've basically just moved straight sideways since we put the trade on. Here's the cool part about a credit spread. When I sell a call spread, it's a bearish position. I want the stock to move lower. Have we had that happen yet? No, we haven't. We have not been right directionally on this stock, on this trade, but we're still up money. We're up 3 cents. We're up a whopping $3 per spread. So we're nowhere near our profit goal. But the cool part about it is we haven't been right directionally on the stock yet either. We have been dead wrong so far, and we're still making money. If we do end up getting our move lower over the next week or two, that P&L is going to work in our favor very, very quickly. So that's why I love these credit spreads. It just takes a tremendous amount of pressure off our trading. So no reason to close it out, no reason to do anything on this eBay trade other than just hold it here into next week, and we'll revisit it next week to let you guys know what we're doing. Last week, we put on a trade on Lyft utilizing the July 19 monthly options. And we actually came in and we bought the 62.5 puts for right around $3.60. When I go ahead and buy a long put, the goal there, obviously I want the stock to move to the downside. That's how we make money on the position. I'm willing to risk 50% of the cost of that option. Well, here this morning, you can see price action has gotten down to around $1.70. We actually stopped out of this trade at $1.80 here earlier today, and we took a $180 loss. I still like Lyft on the downside here over the next few weeks, but I have to respect my risk management rules. I'm willing to take a small loss. I am not willing to take a large loss because then it's going to take too long to recover. If we can keep our losses small, it's going to take the pressure off our winning percentage. It's going to be easier for us to get the numbers in our favor long term. If I can keep those losses around 50% and my winners are at 100%, well, we can clearly do some math there. A winner is going to help us recover from a few losers. So it's always difficult on Lyft, as an example, because I still like the downside. I really didn't want to take the position off, but I had to respect my risk rules. We took it off, we took the loss, and we move on to the next trade. So we'll certainly look at Lyft here next week. We have a holiday shortened week next week with the 4th of July holiday. Markets are only open half day on Wednesday. They are closed on Thursday. So we'll take a closer look at Lyft potentially next week or the following week and look to see if we can get a new trade on to try to battle back and recover from this partial loss that we took here today. All right, so if you have any questions on the gold position, the new one that we took a look at here earlier, any questions on the eBay trade or the Lyft position, feel free to post a comment here in the blog, post a comment on the YouTube video, or send me an email directly. My email is mike@netpicks.com, and I'd certainly be willing to connect and answer any questions you might have. So I'm going to go ahead and wrap this video up here. Enjoy your weekend, everybody. Enjoy the holiday next week, and we'll hopefully be back with you guys next week with an update on our open positions, as well as taking a look at a new trade. So we'll talk to you guys then.